Good morning. My name is Seth, your Metro Detroit real estate expert, and with me, as always, today, your mortgage expert, Steve Frost. How you doing today, Steve?
Fabulous. Thank you.
Awesome. It is our first market update of September, so we're going to go over what was shaking and baking in August. So for August, our the biggest hot topic of the whole entire month was rates. Obviously, right? We saw rates take a that was last month that they took a whole point drop, right, Steve?
Really like over the last 8 weeks.
Okay.
So it's been the last 2 months is when we've really seen rates start to move. I guess you could say from looking at a chart right now. So from July 1st is when the trend really changed directions.
Okay. All right. Good deal. Now, on July 21st, we went over this a little bit last month. In support of the goals, the committee decided to maintain the target range for the federal funds rate at 5.25 to 5.5%, right, Steve? What exactly does that mean?
So it's important to know, what the Fed funds rate is, right? So the Fed funds rate is essentially the rate of interest that the Federal Reserve or like charges basically for banks to lend funds overnight. It's like an overnight rate where you borrow money for a very short term. So maybe think of like a massive company like an AT&T, like they might borrow money overnight for payroll for until they have a certain amount of receivables like the next day. So
Okay.
that's what the Fed funds rate is. And so what the Fed's doing here by saying they're going to maintain this at 5.25 to 5.5%, or why it's been that high, is to limit resources and cost large corporations more money, with the goal of them slowing down on their investment and slowing down on wages that they pay. And it doesn't have anything to do with the borrowing money to make the payroll like overnight or whatever it might be. But they're trying to get companies to spend less money, keep more money in house. Therefore, slowing down how much money people are making, slowing down innovation and stock prices. Again, just trying to get the economy to slow down.
Okay. I gotcha. All right, so we talked about this a little bit last month too. The Federal Reserve is stuck to the script and holding monetary policy unchanged, but strongly suggested a rate cut is likely in September, which has been the buzz of the market right now. So we still are on track to see a rate cut in this month, right, Steve?
Yes.
Okay, perfect. Unemployment. Rate rose 0.2 percentage point to 4.3 in July. And the number of unemployed people increased from by 352,000 to 7.2 million. So this is a big indicator, right? Steve, you talk about this all the time. Unemployment rate has a big factor in doing with the rates right now, correct?
Yep. And so when we get into this a little bit deeper, the reason we're going to talk about labor. So the big thing that we hear about in the news and in headlines is inflation. Inflation's so high, the Fed can't lower rates until inflation comes down. Well, the Fed has come out and said very clearly that they're happy with the current growth rate of inflation, which is important to know. So inflation is going back to only growing at 2%. Inflation is not going down, it's the growth rate of inflation. So why does labor matter? Why does unemployment rate matter? Why does unemployment matter? Why does it matter how many jobs we create? Because what we're trying to do when you're in an inflation situation like we are, and you have to understand, the inflation situation that we are is consistent with any global pandemic inflation. It is transitory. The problem is that we were just way behind on knowing that certain information lagged, and it got into this. We just acted too late. But global inflation is always happens after a pandemic because there's pent up demand, a lack of supply, and then the price on everything skyrocket when people can finally buy stuff. So the reason we watch the employment market though is because when the unemployment rate is low and when there's a significant amount of job openings, like at one point we were over 2 job openings for every able-bodied worker. So what that means is when we're trying to get the Fed and everybody else is trying to get people to spend less money in order to get them to stop buying things, to get companies to lower prices and to reduce profit margins and things like that, to ultimately reduce employment, what happens is, rather than changing your spending habits, when you have a choice of staying at your current job or going to another job and saying, hey, I'm really good at my job, you're looking for somebody that'll do the same thing. If you'll pay me 10% more than I'm making, I will move to your employer. And so what was happening was rather than people are changing their spending habits, they were going out to making higher wages at different jobs. And then they were also taking on second jobs, part-time jobs, in some cases, third jobs. And so when that labor market's really heavy and really strong like that, it's hard to tamp down inflation because you can just work more or get more money rather than change your habits. So that's why we look at the employment rate so closely.
Yeah, good deal. Now the mortgage rates they dipped to the lowest level since February, which I touched on this last month. So this is April of 2024, and there's where am I at here? Let me look at this chart. Okay, yeah, so this is going over the past few months here. So we dipped down here into August. We were at throughout the summer in May, we were at our highest level where the demand for the buyer demand, even though like in a normal market that would be one of our hottest months, it was actually one of our softest months this year just because the mortgage rates were so high and the buyer demand just wasn't meeting what was on the market at the time. We still had a very low inventory at that time, but rates were just keeping people on the sidelines. So now we've seen last month that since the interest rates have gone down a little bit, we do see that buyer demand picking up a bit, and we do see our inventory going up as well. So we'll cover that too. So this is pretty much what I just covered. So this is the demand based on the rate. So if we look here in May, we were at our peak, just over 7.5%, where people they just couldn't afford what they wanted to get into. If they were looking to downsize or upsize, that monthly payment just wasn't going to make sense for them. Would you agree, Steve?
Yep, I agree.
So this is a chart just giving you an idea of what that would look like. So if you have a $500,000 house in April of 2024 with a 7.52 rate, you're looking at $400 difference, $375 difference in a monthly mortgage payment, which over the year and year over year, that makes a humongous difference in as far as affordability goes. And this is another thing that I just touched on. So there's a large pent up stored demand. So there's a lot of people that are looking to downsize or looking to upsize, but they just haven't had the ability to do so because 70% of the people in America right now are sitting at an interest rate of 4% or less. So if you got someone like grandma and grandpa that are living in their big old house and they want to downsize and they have a 3-4% interest rate, and if they downsize to a ranch that's smaller, they're going to pay the same amount and they're going to have a higher monthly mortgage payment. So it just doesn't make sense for a lot of people to put their house in the market and make a move right now. I went over that. Yep, went over that. Home prices. So experts are forecasting that we're going to lean towards moderation home growth for the next 5 years. Again, Steve and I have touched on this on a national basis. We are starting to see that rate go down significantly. We're about 4-5% rate right now as far as home growth goes. But here in Metro Detroit, we still are seeing a pretty fast pace appreciation rate year over year. I think it was like, 10% last year in some markets, right, Steve?
Correct.
Yeah. So here, every market's going to be a little bit different, but overall, we are going to see a U.S. nationwide basis things start to get to trend downwards. We don't mean that we're going to see prices fall. We're just saying that the growth rate is going to shorten. And that's pretty much all I had for you today. Anything more on rates for you, Steve?
No, I mean, you show some of those averages and things like that, and looking at it on the main street and the way the markets are today. I was locking purchase transactions yesterday at 6.125, 6.25%. I've got 2 refis in process right now at 5.99%. So, and I've got some 15 years closer to 5. And so we're really already starting to see a big change in these rates. So it's important to know that when the Fed meets on whenever it is, I forget, can't keep track of all these dates, mostly because my kids are back in school and I literally have no idea what's happening ever anymore. It's a train wreck. But anyway, once that Fed meets, there's not going to be this big change in mortgage rates. The change has already happened. The market is anticipating what the Fed's going to do. And right now, believe it or not, there's a very strong likelihood, and the markets are anticipating they lower rates more than 0.25%. If they only drop their rate 0.25% and they don't have a real positive outlook for what their policy is going to be doing over the next 12 months, in the press conference after, there's a high likelihood we could see rates even go up a little bit. But it should be continuing to trend down as there's some different factors at play. But realistically, we're playing right around 6% right now for your well-qualified buyers. And it's a nice benefit. I mean, we're doing some great things with helping people out that bought homes, anytime really in the last 12 months.
Good deal. Well, I appreciate it, Steve. As always, we'll see you next week. Thanks, guys.
All right.